Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
Excellent. Okay,
Right.
So we're ready to move on.
So we are going to dive in like we usually do to our charts. We've got some questions emailed to us. If you have questions, please feel free to throw into the chat, and hopefully we can get everyone's questions and concerns addressed. And
Yeah. All right. So go ahead, Christine. Let's move forward. We can move forward through the first few slides pretty quickly. For those of you again who are on the call, know that Paul and I look at a variety of risk indicators. I'd say a good 10 to 15 on a daily basis, perhaps even more. Credit default swaps. This is the major indicators, and it is showing elevation, but not anything, to be overly concerned about in terms of credit at this point.
right, higher than it historically, but it's really come down off its highs over the last few months. Generally, directionally, good time, but it's still at these higher levels, so it does say it's something to pay attention.
And it's not common to have, like, again, we always say that the market's a breathing mechanism, and so is in breath, out breath, in breath, out breath. And you would expect to see that with even our risk indicators. So nothing here to be alarmed about. Certainly nowhere near the experience in 2008. So we're not overly concerned yet about it. So let's move forward to the next slide. Let's see what we have.
Okay.
Same thing with spreads, elevated, but again, higher than they have been. What? This is a 2-year term.
Let's go back to 21.
Okay, so it's not really a long frame of reference. They're elevated, but as elevated as in the past. Not enough. Directionally, remember, the most important thing is the slope of the curve and direction. And you can see we have a little bit coming off here as there's been what we call a relief rally over this, last 6 we've seen this.
Yeah, about that,
Yeah, it doesn't mean that a lot has changed in the backdrop. So we'll show you that later, but nonetheless, the concern about credit isn't there. Next slide, please.
These are just metrics that track implied volatility or what the market is pricing days plus forward on what it expects moves to be. It's a lot of information. Generally, it's higher than it's been in the past. All looks at the past 2 years or so. Before this, the average was slightly lower. We moved into this post-COVID era where volatility is higher, which intuitively makes sense. I mean, there's a lot more uncertainty out there in regards to policy, the global situation, markets, supply chains, everything.
Exactly.
So,
And what it speaks to is essentially here is the level of volatility. There's greater reactions to the news, to the headlines on a daily basis. Really, that's what it comes down to. So it's our job to take the noise out and just stay focused on data. But this is important to us because volatility will rise when things get very difficult. So,
right.
But this isn't anything, just that the baseline now is higher than it has been. Next slide. So leading economic indicators. Now you can see this is the LEI is a group of economic data that's put together, which includes yield curve, which we'll go through, and market performance, as well as consumer confidence and what or 8 other indicators.
that track health of the consumer, health of manufacturing.
Exactly. So we are, since the Fed has started their rate hikes, you can see that the leading economic indicators have turned negative. Now, this is indicative of us going into or already being in a form of a recession. Now, this is a different recession, I would say, than any one that I've experienced in 36 years. Doesn't mean we're there yet, but it's definitely leading in that direction. And LEI is good, 6 months forward generally as a good indicator.
Yep.
So this is showing we're on our way. There's a very strong signal towards recession. Anything you want to add to that, Paul?
Yeah, we had this same chart last month, and this has been updated to, this is looking at October's data. And it's just continued that trend down.
Yeah.
So it's,
And this is to be expected. I mean, this is what the Fed wants. This is why they're raising rates, is to slow down the economy. The question that everyone has, and we certainly have the same, are they doing too much too fast?
will they go too far?
Will they go too far, which is very typical for the Fed, by the way. So let's go to the next slide. The dollar.
This is a long-term chart going back to 1960s. And this is tracking the DXY, the US dollar index, which is a basket of currencies, but really represents the strength of the US dollar in the world.
Yeah, and so one of the things, why is this important to us? There's a lot of reasons, and some people have been asking this question. Well, the strength of the dollar speaks to the price or the cost of us being able to import our goods, number one. Number two, why do we look at a long-term chart? Because as you know, we have been, one of our theses is in the long run, we believe that the dollar will not be the reserve currency. And one of the things that you see here is you see each one of these spikes. If I was able to go show this to you, each one of these spikes, we would expect when there is any type of disruption around the globe that there's a flight to quality, which is the US dollar. What we're seeing here, Paul drew in a line. So undoubtedly, we have a lot of uncertainty. We're looking at war in Ukraine and some other conditions. What we would ideally want to see is that the dollar would be able to penetrate strongly above that trend line that Paul put in. And what we're seeing is it reversed when it hit that trend line. Why is that important? Because that indicates to us that our thesis around the dollar not being the reserve currency in the long run would still hold here. Paul, you want to?
Yeah, it's saying that it's also saying that there's less demand for dollars based on this.
Mm-hmm.
That it wasn't able to achieve the same level in past crises.
Yeah.
Yeah.
So in other words, there's some confidence being lost in the dollar as the reserve currency. Now you will see there's some posturing now that's taking place where a good amount of the oil around the globe is traded in US dollar. We are the reserve currency. We are the currency of choice. And what we're seeing now is that with the war occurring in Russia, that some countries are now not trading in the US dollar for their oil. And that again speaks to supply and demand. If there's less demand for something and more supply, it generally means a lower price. And this is what we have to watch in this particular.
Right, there's been lots of talks of the BRIC nations forming their own central banks so that they can get around SWIFT network or have their own way to trade with each other without having to use US dollars, because right now they have to take their currency, buy US dollars, buy oil, and the opposite is true too. They need to sell oil into dollars and then convert the dollars into their native rate. It just adds lots of extra steps and friction for those countries.
Yeah, and Paul, just very quickly mentioned SWIFT network. This is very important because that's the global network of banking where we all clear through. And so if there's less inclination towards that system, that means that things are starting to unravel, I would say.
Right, and already, I think I had just read a statistic that was saying that China and India are buying almost all of their oil currently from Russia in their own currencies at a steep discount.
Yep. Yeah, that's happening. And so this is a big deal, yes, and you must understand that if the dollar no longer became the reserve currency, what we would see is a significant spike in inflation. We think it's high now. We would have much higher inflation because we are an import dependent country
Right.
for our goods.
Right. We export most of our services, right? That's the big
Yeah.
service exporter. And when it comes to actual goods,
We're importing. Yeah. Next slide. So this is a big deal here, that the yield curve is inverted.
this is one of the wonkiest yield curves I've ever seen.
Yeah, Paul will explain this to you, but this is what we call an inverted yield curve. And in my 36 years in the industry, I have never seen an inverted yield curve that did not lead to a recession. Okay. Again, I'm going to say that again. I've never seen an inverted yield curve to this extent. Now, this is the weirdest one I've seen. An inverted yield curve that did not lead to a recession. So this is predicting. This is one of the indicators in the leading indicators.
Yes.
So you want to explain what you're
This
seeing?
is the
for-
bond market saying that they believe in the future rates are going to go down. What this chart shows is on the left side is short-term maturities and on the right side is long-term maturities, so anything 10, 20, 30 years out. When you have the short side paying you more, which is what this chart's showing, it's paying a higher interest rate. It's saying that there's much less incentive to go out longer or to tie up and lock up your money for 20, 30 year periods because you're going to be paid less. That's a warning sign that says, hey, now's not the time to be spending money hoping for growth because you want to basically hoard your money or invest it in more liquid, less long-term types of vehicles.
So what this shows, just by way of value, the 1 year you can get at 4.3%. So the 1 year treasury you can get at 1.3% or 4.3%. The 10-year treasury you can get at, what is this? Like 3.1.
It's like
I can't see it. Oh, you got 3.5. So
it's about a 1% difference.
yeah, that's huge. Yeah. It's
So
definitely-
intuitively, right, would you want to lock your money up for 10 years and get 3.6% or so, or lock your money up for 1 year and get 4.8%?
And the answer to that is it depends upon where you think interest rates are going to go
Right.
a year from now, or 2 years, or 3 years, or 5 years. So this is we are generally staying on the short end of the curve at this point. It's paying to stay on the short end of the curve.
And this curve, to get a little into what the Federal Reserve's saying, to where they're saying they want to keep interest rates higher for longer. They're going to most likely slow down the rate of increases, but they've telegraphed that they want to keep rates high for an extended period. This chart is almost in direct conflict with that narrative, saying that the market or bond markets in general are saying no. In the short term, yes, rates will be high, but in the longer term, the Fed is going to have to start cutting rates, and that's sort of the bet that bond markets are
They're making right
making
now.
at this point.
Yeah, they're thinking
Which
that
can
the
always
Fed-
change, but that's what.
They're thinking that. Now, this is really interesting because this morning we had really high payroll numbers, much higher than the street had expected. So now you saw the market pull back, I think initially 400 points, and now I think it's less. But now what's happening is you're seeing a concurrence of literally confusion, really, because
Lots of confusion.
lots of confusion, because on one hand, the Fed did come out this week and say that they would slow the rate of their ascent of rate hikes, which is important. But then you have a data point that comes in that contradicts what they want to do, and that is the payroll number, which was significant. So where the Fed is going to end up, what are they going to favor in the end? I'm not sure. I can't say.
I'm not sure they know.
Yeah, I'm sure they know. And I don't blame them. So anyway, so that's, I hope that helps you there. So let's go to the next slide, which is inflation. And this, Paul, this brings us to the question that somebody asked about the fact that they noticed that the numbers are showing that inflation has come down. We want to say this again. We are on the record saying we think we are in a reverse stagflationary environment, and what that means is that the price of necessities are higher. So necessities, healthcare, rent, food, energy. Am I forgetting something?
Yeah, I mean, this chart is showing
he's gonna
things.
show the chart.
It's got food, electricity, shelter, personal care,
This is huge.
household items, gasoline, medical care, vehicles. Some of these things shot up so much
Yeah.
over the past year that it only makes sense for some mean reversion to happen, for some of that to come back down. But ultimately, what we see is that these are going to remain elevated for an extended period of time. Most of the time with inflation of necessities and goods, prices get higher and then they stay there.
Yeah.
They don't necessarily come back down to where they used to be. Instead, they form a new base, but at a much higher level.
Yeah, so the fluidity, what Paul's talking about is that base building is, if we shot up, it would be normal to see this chop, if you will. So if you look at this chart, if you can see this, you can see that we rolled over in some of these things, which, okay, good. But it would be abnormal for us to see a level of chop here, a level of back and forth, and then we'd rest at a new level.
Right, and is inflation really easing if the price of something you depend on, like food or energy, has gone up, just as an example, 100%, and then drops 10%, and all the headlines say, oh, look, everything is nice and rosy.
It'd be very curious to see what kind of Christmas we end up having. I know some of the initial numbers around online buying is high. I don't know about at the stores. But it'd be curious to see what type of impact this type of inflation is going to have on spending.
Yeah, some of the preliminary data that I did see was saying that online sales have hit a new record, which is just expected as more and more people move online. But that brick and mortar sales were flat, so lower than what they were compared to previous years. So we'll see as more data comes in.
I don't like to go shopping, so I'm there. I'd rather do it online. Okay, so next slide, please, Christine. Consumer health and savings. So this chart is, this is pretty intense. If you look at the top line here, is it red, Paul? Is that a red line there you see?
Top red line is measuring personal consumption expenditures.
Yes.
So what people are spending. I threw in a little average line there that just shows above, like, yes, over time, as inflation, more people in the workforce, et cetera, this is always going to go up.
Yeah, we're consumptive, maybe. Who knows?
Well, maybe,
I mean,
right, at some
you know,
point it probably
Yeah,
will, but it's way high above the average, mostly due to over the past year or two, the cost of everything.
Yeah, look at the again, it's about the slope of the curve. You can see, look at the slope of that curve from Corona. And then, I mean, straight up, and then look at the savings rate, like this.
Bottom blue line is showing savings rate, and it's actually reached I don't know if it's an all-time low, but it's definitely over many different time frames.
20-year low.
Yeah.
20-year low savings, that's not good. That's a huge drop. So why is that a big deal? Because savings is what propels economies forward, by the way. This is it's savings that actually propels economics, economies forward as the money supply grows off of this. So what next?
Next chart.
Yeah, next.
So this also relates to the chart we just looked at, but it looks at consumer credit card spending. The chart on the left is showing 30-day delinquency rates, which have started to tick up at the end of Q3 2021. So that's a trend to watch. And then on the right, it shows total outstanding credit balances, which have also started to go up considerably. And I believe recently they just hit a new high. That also started in the beginning of 2021 or so. So these are trends that over the past year have only been increasing.
Yeah, so 30-day delinquency, I mean, it's nothing like what we saw in the mid to late 2000s. That's great.
You can see that the peak there was during 2008, 2009.
Yeah, that was intense. During that time period, you were seeing headlines that consumers had the highest credit score in history at that time. So I always find like these types of headlines always hit when we're near the peak. So this isn't too bad what we see there, that it's picking up. Again, it's directional, that's something to pay attention to, but on an absolute basis, it's not that bad. But you can see outstanding credit card balances. This is something I would say that's critical for us to pay attention to, because if that does tick up, then you're gonna see the delinquencies become higher, I would think, in the end.
Yep.
Okay, what else do we have? So next one. This
Wages.
is a good one. Yeah, this is real wages versus inflation. And you can see the red line there. This is significant. It's the annual percentage change in real wage. So it's negative. So real wage is negative. We're not keeping pace. The wages are not keeping pace with inflation. So this is a big deal.
Right?
And,
People are making the same or less, but the cost of everything is going up.
And I think most everyone can speak to this. So, I mean, it's broad reaching. I would say, pre this time period, the lower income brackets were getting hit pretty hard. And then with this inflation increase, I'd say middle to upper middle class are definitely feeling this. So it's reaching higher,
Right.
even still. And I think with the most recent Inflation Protection Act, or whatever the bill is, you'll see that it reach even higher than it is now.
And inflation is not equal, right? It really impacts those on the lower end of the socioeconomic ladder much harder than those on the higher.
Yeah, but this is reaching higher now.
Yeah, but it's been creeping.
Yeah.
So,
Okay, so let's see the next slide, please. Okay.
I just found this
housing.
chart as interesting. While this should be expected because housing prices have just gone parabolic, that yes, there would be a significant drop in housing prices. That's what that orange red line is. That's kind of going straight down compared to everything else.
Is that now, Paul? Because I
That
can't
is
see,
now.
because we have black and white, so you can't really see what's going on.
Yeah, that's now. And these are other times or other environments where the Fed started raising rates and how housing prices reacted.
Yeah, this is really fair, because this is the fastest rate increase the Fed has made, besides in the 70s. So I see the 70s chart, which I think I can point to, that decelerated pretty quickly too, if it's
Yeah,
that bottom one there.
Yeah,
So,
so while it's expected because housing prices were so high, again, to what Alexandra mentioned earlier, how we look at the rate of change and the velocity of these things and just how drastic that line down is compared to other times in history when the Fed raised rates. So it's worth paying attention to.
okay, next slide. Manufacturing health, global PMI. Okay, so what this is showing just manufacturing across the globe. And you can see that we're going into a negative pattern, which we did back in 2020 and we did in 2008. So
In early 2000s, sorry.
Yeah.
So this again is another recession type indicator that sort of is pointing into that direction.
And this is really kind of interesting too, because one of the things is the market is a leading economic indicator. So you have this piece of data that shows that we're slowing down. But then you also have like the industrials over the last 6 weeks performing well. It's not normal. They don't normally see that. So I'm curious what that might mean. And why am I saying this out loud? Because just so you know, this is how we're always thinking. It's not just about this data, but we're also looking at how things are actually behaving in the market. And the question for us is, when we see some of these industrials performing the way they are, in particular in certain industries within the sector, we question, is it war related? Is it defense related? And we can certainly say that companies that are involved in defense industry are doing well. Yeah. So anyway, we'll see how this plays out. Next page, please. So if you put this in.
This was just a super long-term chart, goes back to 1900s, turn of the century, just to track how markets can, they don't always recover like they have post-COVID, where you have this V up and it's new all-time highs left and right. There can be, even looking at this chart, I mean, in the 1930s, there's a 25-year period before markets hit a new high. in the 60s and 70s, a 16-year period. Even in the early 2000s, it can take years sometimes for, well, the data to turn and.
Yeah, and I could just say, like in the 2000s, like the early 2000s, it took 6 years for the market to recover. That was a steep recession. And if you were in technology, it took 13 years for you to recover. That's crazy to actually think about that, but that really is what happened during that time period. Wow. Yeah. So meaning, I think the reason Paul put this in here is to show you that we have been in a bit of a bear market. So V-shaped recovery would be very unusual.
Yeah.
And we did definitely have it in 2020 during the coronavirus, because there was so much stimulation being put into the market, which is not happening today. So we don't have an excessive amount of stimulation, though at the fiscal spending level, I think at the government level, we're spending more, but from a monetary policy, no.
Yeah.
It's not happening. So,
Next slide.
so you're gonna speak to this because I can't see the colors here.
All right.
So this is the bear market, this is showing the bear.
Right, so this has, let's see, black.
Yeah, and we need to have colored
I know,
slides
yeah.
so we can do this with you people.
Well, basically it's showing the Fed funds effective rate, inflation, and the S&P 500, and how they are all related to each other in some way, where when one starts to turn, you can see that it plays out in the markets with the different peaks and valleys and troughs that are happening on this chart.
Yeah, and so, if you look at this chart, inflation is a long way from where it was, if I'm not mistaken. Is that blue at the bottom of inflation? No, that's Fed
That's
funds.
Fed funds.
That's Fed funds. Okay.
Inflation is above that, and S&P is above that.
Okay,
Basically, this chart shows that there's always these divergent and then convergent phases, and we're at the end, what it looks like anyways, of a divergent phase going into the convergent phase. So we'll see how that plays out. That doesn't bode the greatest.
okay, and then the next
Next
one
chart.
is this one that I think I can see, this one. So the next one is, you can see a bear market. This shows bear market cycles and valuation, and this is from the 70s. So if any of you remember from the 70s, I actually remember it. I was entering college at like the beginning of the 80s, so I do remember aspects of this. And you can see that it took a time. You can see there were, like, for example, in 1966, you saw a big draw up and then a draw down. And then in 70, a big draw up in the market and then a huge draw down. So this big swings in the market are very normal in bear markets. Same thing in a bull market, big swings to the downside. But usually, actually, you see more big swings in bear markets than you do in bull markets.
And it's just something to take in consideration, especially with how we are currently positioned, where we are more defensive overall, that you don't want to fall into a bear market rally or a bull trap where it looks like, oh, look, everything's up 10, 20% even. It's the start of a new paradigm here. Well, actually zoom out and we could still very much well be in this continued downward trend.
And something really important, though, that you have to know, in every market, there is an opportunity. And that's what we're starting to find now, is where the opportunities are. Like, frankly, South America is starting to look attractive from our perspective for a number of reasons, which we won't go into today, but there are pockets of interest for certain. And as we said earlier, inflation in the necessities, one of the plays we have in the portfolio is food, because we know that food prices have the ability to raise really quite indefinitely.
Yeah, there's lots of big picture macro tailwinds that really push that forward too. I mean, with disruption in supply chains, disruption in fertilizers, all these different things that lead to constraints on that market that make it look like, okay, if nothing changes here, then this. So.
Okay, so now we have some questions. You want me to grab the questions? These are going to be questions for Paul. So I'll ask the question.
And I have my phone here, Christine's gonna email them.
Okay, but I got this one
But
for you,
yes,
so
go
let's
ahead.
do this. Is there any good news in the crypto world?
So I could talk about this for hours. There was recently so much fraud with FTX. It paints the whole industry really in a bad light. But I guess the silver lining is that the vast majority of bad actors and leverage has been flushed out of that system. When I look at what is still happening in the space, the actual development is full steam ahead from everything I'm watching. There's still all sorts of development going on different chains, on partnerships with Fortune 500 companies. The development side looks great, right? But the current optics out there for how it's perceived make it look like it's a mess and a fraud. I love this analogy that I recently heard that was just because, well, first off, how many junk and spam and scam emails do you get every day?
Too many.
Right. And so is that a reason to not use email
Right.
anymore?
Yeah, of course
Right,
not.
so with any new disruptive technology that allows people to do things in new ways that we weren't able to before, bad actors are always going to bad act, unfortunately.
Frankly, the market needs to be regulated. I mean, that's the bottom line, the thoughtful regulation, which is always what we
Right,
say.
the biggest problem with FTX was that they were a Bahamas-based company. They didn't have to follow the same rules that US-based companies do, especially when it came to customer deposits. So it led to this whole massive issue that we see today. If fiat on-ramps or exchanges that take customer funds legally have to back them by having one-to-one dollars or whatever, that the assets are actually held there and they can audit that in a fully transparent way, which blockchain technology allows for. All of this would have been avoided. But the fact that people were still trusting the exchanges that are centralized entities, it's very opaque what happens on the back end. You don't actually know what they're doing with your money. There's no transparency there. It leads to these types of problems. Blockchain technology itself, right, is this tool that can be used to minimize trust or find ways that you don't need to trust people. In this case, people trusted SBF and FTX and everyone there, thinking that, oh, they're legitimate and it's going to work, but there's still that element of trust. Into this black box, you don't know what happens with your money, and poof, oh, look at that, it's all gone. Blockchains, right?
It's kind of like a Bernie
contracts,
Madoff scheme, to be honest.
very
with you.
similar.
Mhm.
But if you
Do you
relied
remember Bernie
solely
Madoff?
on
It's the
blockchains
same.
and these things, right? They're transparent by nature. You can audit the code. It's all there. You know exactly what's going to happen. So regulators really need to step up and say, look, these fiat on-ramps, they need regulation. They need to be regulated in ways that protect customer funds, and then that anyone who's then using these on-chain DeFi protocols, decentralized finance protocols that are code-based and not human-based, a lot of that regulation is already built in because you see and know exactly what's going to happen.
You know what, I think I need to recommend that Paul get involved with the regulatory agencies to help them come up with thoughtful
I would
regulation.
more than willingly do this. If anyone knows anybody who wants to have a conversation, please. reach out.
Yeah, definitely. So the next question was thoughts about gold and if we haven't when to sell it. So let's talk a little bit about gold as a whole. You know, what you are seeing is, I'm sure you're seeing it in the headlines that some countries are still buying gold, still have a good amount of gold in their coffers. And, you know, this has not traded the way I expected it to in the environment that we're in. Very honestly, I can say that.
No.
And I don't want to say we've thrown in the towel on gold, but I would say that
Definitely more
it's
frustrating.
it's been more frustrating than not. And I can't say that our call around gold has been great. Yeah, I can't say. And so the thought here is that we don't know when to sell because we don't own it for our portfolios at this point in time. And the way the charts are trading, it's pretty, consolidating, Paul? I mean,
Yeah, it broke through a support level to the downside, but then it's since rallied
I know.
from that. So
But it
it's,
didn't break its
but
resistance.
it hasn't hit a new high. It hasn't
Yeah.
broken resistance.
Yeah.
It's definitely a frustrating chart,
Yeah,
given all the metrics out there that would make the case for gold. Now, when you look at other countries,
central banks are accumulating.
right, central banks are
Yeah, they are
accumulating,
accumulating
and
it.
you look at
Mhm.
how gold has performed in relation to other currencies, not the US dollar, right, but to
Yeah.
other currencies, it's actually
It's outperformed. Yeah.
considerably well, so mixed bag.
I guess it depends which country you live in.
Right, that's a big one. actually.
Yeah, it is a big one. But do know that central banks are accumulating gold, so there's something to it. Just what exactly? So, as Paul and I had the conversation about the dollar, moving away from the dollar as a reserve currency, we went from gold to the US dollar. What's going to be next? I don't think it's going to be gold. I think it will be more like a basket or something else.
Mhm.
So that's that. Okay,
I've got a
so,
couple questions here that
Okay,
have
go
just
ahead.
been sent in. Let's see, is it possible that consumer spending, savings, and credit card debt are related to people losing their jobs and needing to use their cash or cards?
yes, and there's also jobs available too, we know, but yeah, I would say that has a good portion of it.
Yeah, you pair that with the cost of everything going up
Yeah.
too, and the wage growth that we've shown is
Yeah.
not keeping up, and
Yeah.
it would have more people lean on or rely on credit to sustain their current lifestyle.
Yeah, the big thing is we see big layoffs in technology, and that's a very high paying field. And so where are those people? And it's pretty much across the board in technology, you're seeing the layoffs. So that's a big swath of people, I think, who lost their job in the last couple months, I would say, Paul, if we looked at the data.
Yeah.
So I think it speaks more to the price and the cost of living that's creating the credit card debt.
Definitely. Another question, don't wages have to catch up? And if so, is that another accelerant to inflation?
That would be, I don't need to laugh. Don't wages have to catch up? They don't,
They don't, I would say
They
historically,
don't.
they haven't.
and they don't, and they haven't, and I didn't mean to laugh because I think it's really awful.
It's a great question.
It's a great question, and it speaks to the control, I think, of a lot of companies that are paying more attention to their bottom line than the bottom line of humans.
Right, I think
Which I think is a
since
problem.
the sixties or seventies, the last I saw, if wages had kept up with productivity, minimum wage would be something like $46 an hour or something like
We'd
that.
be off the charts, so I would love it, I don't know who asked this question, as a humanitarian, I would like to see, that change, because certainly I think we have a whole group of people who could use it. And, but unfortunately, the truth is no, it does not keep up. And it will not catch up unless something dramatically changes. More questions?
Yeah, right.
We have more questions. Hold on a moment.
So why does gold have any importance in investing in world economy? So what role, perhaps, maybe does gold play?
I think it's just more of a historic.
Thousands of years of history as a
Yeah.
store of value.
Mhm.
And so a lot of people put a lot of weight or credibility behind that, thinking that, okay, well, it's worked for the past several thousand years, but why wouldn't it work going
I
forward?
mean, because we've only been on the gold standard, what, since the seventies? Somewhere in the mid-70s?
No.
Yeah, right? I mean, off the gold
Yep.
standard, excuse me. So on the dollar, the US dollar reserve standard since the mid-70s. So that's not really long in relation to the history and how long we were on the gold standard. So maybe old habits die hard, or, I do find it interesting central banks are buying this asset class.
Right. But it's mostly around that idea of it's a store of value asset. Because yes, gold does have some limited industrial use, but that's a really small thing. So where's its value coming from? The idea that, oh, here's a potential hedge against uncertainty, or a historical store of value, and the belief that that would carry forward into the future.
Do we have anything else? I hope this is helpful. While Paul is looking this up, we do have your emails, and we will be emailing you and asking you what format you want to see, if this is a helpful format for you, because we do this for you. This isn't for us, this is for you. And we want you to understand what our thinking is with the portfolios, with your money, and how we're operating. Anything else?
Yeah, that's
That's
it for today.
Okay, so perhaps we will be sending you a survey to ask you on how this hits you and what you would like to see going forward. But we thank all of you for sitting with us today. We hope you had a nice Thanksgiving, and for those of you who are in the Northeast, let's hope for, well, I want a mild winter, maybe, you know, maybe you want a lot of snow, but.
I wanna go sledding
I'll take
with
it.
my kids.
Oh, okay, well, there you go.
But I could do without the frigid cold.
Well, we can use some water, I'll think of that. Anyway, thank you so much for meeting with us today, and again, you know where to reach us if you need us, do email, and hopefully we'll hear from all of you soon.
Excellent. All right,
Thanks
thank
so
you,
much.
everybody.
Have a good one.